Hello everyone, welcome to BISP Solutions. So today we are going to see Accounting Standard Codification 360, 405 and 430. So Accounting Standard Codification 360 under US GAAP stands for Property, Plant and Equipment. So it is a section of the US GAAP Accounting Standard Codification that governs how companies account for their tangible, long-lived assets. It includes guidance on capitalizing costs such as interest on construction and addresses the impairment and disposal of these assets. A key aspect is the process for determining if an asset's carrying value is no longer recoverable, requiring an impairment loss if the carrying amount exceeds the fair value. So impairment loss will happen when your carrying amount is more than the fair value. So in that case, it will be an impairment loss. And if the asset's carrying value it's no longer recoverable, then you have to record an impairment loss. Now there are some key aspects of Accounting Standard Codification 360. First, we'll discuss the scope. So it covers tangible long-lived assets, which is known as property, plant and equipment. That is, we also call it PPE. It has two main subtopics. First, it says Accounting Standard Codification 360-10, which focus on impairment or disposal of long-lived assets applying to both individual assets and assets group. Then here another subtopic is 360-20. It provides a guidance for real estate sales and sale leaseback transactions. Now asset impairment means under this subtopic, this mandates testing for assets recoverability when circumstances suggest its value might not be recoverable. So recoverability test is like an asset is considered non-recoverable if its carrying amount exceeds the sum of undiscounted cash flows expected from its use and eventual disposition. And how you will measure the impairment loss? If asset is not recoverable, an impairment loss will be measured as the amount by which the asset's carrying value exceeds its fair value. It's written over here on the Excel sheet. Now we'll see what disclosures will happen. So how impairment will happen, like carrying amount means, suppose if your asset value of the asset is, suppose you have purchased the asset of rupees 1 lakh, you have charged the depreciation of 20,000. Now your carrying value will be, you can say 80,000. Now suppose this was in year 1. Okay, in year 2, next year, your opening balance of the asset will be 80,000. Again depreciation, suppose SLM is there, so 20,000 depreciation will be charged. Then you will have 60,000 carrying value. Okay, so now suppose in year 2, if you find out the fair value of this particular asset, if you sell in the market in the second year, this is asset which was purchased of rupees 1 lakh. If you sell it now, the fair value of this asset is suppose 50,000, and you are showing in your books the asset as 60,000. That means 10,000 more it should be reduced in your books of account because it is overhyped in your books. So you will reduce 10,000 more to bring this amount equivalent to the fair value. So this is nothing but your impairment loss, because you have purchased at 1 lakh, means you have purchased at a more price and you are charging the depreciation, and in the second year your asset should have been depreciated and the carrying amount should be equal to the fair value, but it is not the case. In that case, you will charge a more loss and reduce the value of the asset, so which is known as impairment loss. Now your asset value will be 50,000, which should be equal to the fair value. So these and these two will be the same. So this is only carrying value. If it is more that means 60,000 was more than the fair value, in that case impairment loss will be charged. So this is your impairment loss. Now what are the disclosures impacts? When an impairment loss is recognized, entities must disclose specific details in financial statement notes, such as description, what's the description of the impaired asset, the facts and circumstances leading to impairment, the amount of the loss, and the method used to determine its fair value. So Accounting Standard Codification 36010, it differentiates between accounting for long-lived assets classified as held and used versus those held for sale. So this ensures that the companies correctly record the value of their fixed asset and recognize any decline in their value when they no longer meet the recoverability criteria. So how you will do the impairment? How will you do the impairment testing? So this standard outlines how to test for impairment when a long-lived asset is held for use. This involves a two-step test to see if the asset's carrying value amount is recoverable or not. Now, what are the impairment indicators? Such as significant decrease in market price, adverse changes in physical condition, or current projected cash flow losses. Okay, so these are the impairment indicators. If this happens, then you have to impair your asset. Okay, now Accounting Standard Codification 360, it applies to tangible assets that are long-term in nature. They are used in operations and not held for sale. These assets include land, buildings, machinery, vehicles, furniture, and equipment. This standard outlines the criteria for recognizing and measuring property, plant, and equipment, as well as the related disclosures in the financial statements. Now, how will you initially recognize it and do the measurement? So, when a company acquires or constructs a qualifying asset, this standard requires recognition of the asset on the balance sheet. This asset is initially measured at cost, which includes all the directly attributable cost necessary to bring the asset to its intended use, which may include, like, first initial recognition will be done on cost. It will include purchase price, transportation cost, it will include any installation fees, and then maybe any other cost which are directly incurred to make the asset to its functional position. Okay, so these all will be part of the cost. So initially you will record the asset at cost. So I assume my asset cost is 1 lakh. And how will you do the subsequent measurement? So after initial recognition, Accounting Standard Codification 360 provides guidance on how to measure property, plant, and equipment in subsequent periods, like how we are measuring in the future periods. This standard offers two options. First is a cost model, second is a revaluation model. Okay, so two models are there. First, it's your cost model, second is your revaluation model. So under cost model, assets are carried at their historical cost. Historical cost less accumulated depreciation. So in this way you will recognize whatever is the cost less accumulated depreciation and if there is any impairment loss. The same we have done here, you see, cost less accumulated depreciation less any impairment loss here. Then second method is the revaluation method. On the other hand, you have second model, that is revaluation model. It allows the company to measure asset at fair value, which is determined based on the market price or independent appraisals. However, the revaluation model is used less frequently. More used is the cost method. Now depreciation. Depreciation is a key concept in this Accounting Standard Codification 360. It represents the systematic allocation of assets cost over its estimated useful life. Companies must choose an appropriate depreciation method such as straight line method, unit of production method, written down value method based on assets expected pattern of consumption or wear and tear. So this selected method should reflect the economic benefit provided by the asset to the company over its useful life. Now, as again and again you were hearing from me the word impairment. So impairment means it requires a company to test property, plant and equipment for impairment whenever events or some changes in circumstances indicate that their carrying amount may not be recoverable. If the carrying amount exceeds the recoverable amount, which is higher of the asset's fair value less cost to sale or value in use, then impairment loss must be recognized in the income statement. Now, what will be the journal entry to record this machinery? Suppose a company called XYZ Manufacturing purchase a new piece of machinery for their production line. Now, the machinery cost of the machinery is 1 lakh, and there are additional cost of 5,000 for transportation, and for installation it is 3,000. So how will you record the journal entry? So we'll debit the machinery, that is, we can say property, plant and equipment. It should be because these costs will be added, and to this particular cost, you see the cost will be added. These all costs are because to make it functional, this transportation needs to be done and installation needs to be done. So it will be 1,08,000 PPE to PPE account debit to cash or bank account credit with 1,08,000. Okay, this will be the journal entry. Now, what will be the depreciation entry? So suppose what will be the depreciation asset? Suppose your cost of machinery, it is 1 lakh. Now 1,08,000 is your cost of machinery, and there is no residual value. Suppose the useful life is 10 years. Life of the asset is equals to 10. So how will you calculate the depreciation? So depreciation will be whatever is the cost of asset minus salvage value. It should be divided by your life of the asset. So in that case, your cost of the asset is 108,000. There is no salvage value, so it will be this, and it should be divided by 10. That is your life of the asset. So 108,000 will be the depreciation that needs to be charged every year or per year. Okay, so your journal entry will be depreciation is an expense, so depreciation account debit to machinery account credit, because the value of the machinery gets reduces. So machinery account credit with amount 108,000. This is your journal entry for depreciation. Okay, so this was all there in Accounting Standard Codification 360, property, plant and equipment. Now we'll go through the another standard, that is Accounting Standard Codification 405. That is your liabilities. So Accounting Standard Codification 405, it provides guidance on the accounting and reporting for liabilities. It covers how entities should record and present their obligations to other parties, which can be for goods, services or other legal settlements, and applies broadly to various types of liabilities. There are some key aspects of Accounting Standard Codification 405. It addresses the liabilities in general with specific subtopics for certain types of liabilities and situations. If you talk about the purpose, it establishes the rules for recognizing, measuring and disclosing liabilities on financial statement. Liabilities category. It applies to both short-term and long-term liabilities. So when the ultimate goal is to measure all the financial liabilities at fair value, many current liabilities, they are still measured at their settlement value. So the amount of cash to be paid. Now this standard provides guidance on how to account for and disclose liabilities. A liability is simply an obligation you owe to another party. It could be for goods, services, or even a legal settlement. So liability fall into three main categories. First is the current liability, you all must be knowing. Current liability means obligations which are due within 1 year, like accounts payable or short-term loans. Then you have non-current liabilities, means obligations that are due beyond 1 year, like long-term debt. Then you have contingent liabilities. That means any potential obligation that depends on outcome of the future events, like lawsuit. In that case, that is your contingent liabilities. For example, suppose you owe a small business and you purchase $10,000 of supplies from a vendor on credit. The 10,000 you owe is your current liability. Specifically, that's your accounts payable because it's due within a short period. Usually you can say 30 to 60 days. So that's your current liability. Now how will you recognize the liability? So it says Accounting Standard Codification 405 says a liability should be recorded when first three conditions should be satisfied. You should have a present obligation which is due to a past event. Second, it should be probable that obligation will require settlement. So probable should be there that settlement will happen. And third, the amount should be reasonably estimated. Amount reasonably estimated. These three conditions, if they are satisfied, then you will recognize or record a liability. For example, if you borrow 50,000 from a bank today, that's your present obligation, and you know you will have to pay it back. So you have to record it as a liability. Now, what are contingent liabilities? So these are liabilities that depends on some future event. For example, if a company is being sued for it has been sued for $1 million. It's not a guaranteed liability. It depends on what is the outcome or result of that case. So here, how you will account for your contingent liability. If your liability, suppose it's probable and the amount can be estimated, then you will have to record it in your financial statement. If it is a reasonably possible but not probable, so you have to disclose it into the notes to your financial statement. If it's a remote, means unlikely, highly unlikely, so in that case, no need to record it or disclose it. Let's say your company is facing a legal claim for $5 lakh. Your legal team thinks that there's a 70% chance you will lose, and they are estimating the damages of $3 lakh. Since it's both probable and the amount can be estimated, so you have to record a liability of $3 lakh. But if the chance of, because there was a high chance of losing, 70% chance was there. Suppose if there's a chance of losing was only 30%, then you would disclose the details in the financial statement notes. And if the chance was remotely, let's say 5%, you will not record it or disclose it. But then what are the disclosure requirements? How will you disclose it? So the liability disclosure is essential for its transparency. So you need to, for disclosure purpose, you need to disclose what is the nature and amount of liability. Nature and amount of liability you need to disclose. Secondly, you need to disclose maturity date for your debt. Maturity date. Third, you need to disclose terms and conditions. Like interest rate for loans. Fourth, you need to disclose any significant contingencies, even if they are not recorded. So if there are any significant contingencies. Okay, these all things are you need to disclose it. So at last we'll conclude about accounting standard codification 405, that it covers your accounting and disclosure of liabilities. Here we also included what are the current liability, non-current liability, and contingent liability. We also how to recognize the liabilities when they are probable and measurable, and what are the disclosure requirements. This build trust with the stakeholders. So that's all we discussed in accounting standard codification 405. Now we'll see about accounting standard codification 430. That is your deferred revenue and contract liabilities. So this standard provide guidance within the US GAAP for deferred revenue and related contract liabilities, specifically linking to guidance for vendor sales, incentives, and other contract related items. It essentially serves as a pointer to more detailed accounting standards for deferred revenue under the new revenue recognition rules. Now there are some key aspects that we will discuss here. First, we need to see what is deferred revenue and what is contract liability. So deferred revenue means this refers to revenue received by the company for goods or services that have not yet been provided to the customer. So those goods or services that have not yet been provided to the customer. And contract liabilities means this is a very broader term that encompasses deferred revenue, reflecting an entity's obligation to provide goods or services to a customer for which the entity has received consideration. Now, what are the vendor sales incentives? So, specific focus of accounting standard codification 430 is on deferred revenue related to vendor sales incentives, such as refunds or rebates that customers may claim. So this 430, if you talk about this, here we'll identify the contract. In this standard, we generally identify what is the contract with the customer. We identify the separate performance obligations in the contract. We also here determine what is the transaction price. We allocate this transaction price to the performance obligations, and we recognize the revenue. Here it also provides a link to accounting standard codification 606, which is a direct link to more comprehensive revenue recognition standard that we'll see this in detail in accounting standard codification 606. So this accounting standard is the current single source of your US GAAP. Here we will see about your, as I said, deferred revenue. What's the deferred revenue? What's the not deferred revenue? We'll see that's deferred revenue, deferred liabilities. The revenue which will be deferring it for the future terms. You will not recognize it now. So that's a deferred revenue. And there are some contractual liabilities which arise due to some contractual obligations that you have to recognize in your contract liabilities. And this has a direct linking with accounting standard codification 606 that we'll cover there. This standard will be more covered in detail in accounting standard codification 606. Okay, so we have seen moreover this accounting standard codification 360, 405 and 430. Yeah, so that's all for today. If you have any questions, please contact BISP Solution. Thank you all for your time.